Hello everyone and welcome back to these sessions on financial reporting. Now, if you are attending as a CA final student or CMA final student, this topic is going to be very important for you. The topic that I'm just about to begin. So this topic carries a lot of weightage in both CA and CMA exams. Not only that, this topic is going to be a base for lot of other topics that you are going to learn, and that is why I would want to take this opportunity and do this thing for you at the earliest possible stage. And title of this topic is basically financial instruments, which is covered in a set of 3 different Ind ASs, that is Ind AS 32, Ind AS 109 and Ind AS 107. Now the role of Ind AS 107 is basically negligible. It is more of just disclosure requirement from examination viewpoint. That is not an important area, and neither I am going to put any specific focus on Ind AS 107. What I would suggest is, from your institute study material, you should definitely go through what is the content which will be required for Ind AS 107. There won't be even doubts because it's just a list of required disclosures by the standard, nothing else. Let me now remind you something about the basic content of any accounting standard or any Ind AS, or you talk about IFRS, whatever. The content of any standard will be comprising of 4 segments: recognition, measurement, presentation and disclosure. So you should understand each standard is going to talk about recognition, measurement, presentation and disclosure. Now let us first be clear with the meaning of each of these, though I would have explained this in earlier classes as well, but let me take that opportunity to explain it again. Maybe some of you have got started with your classes with this topic. So I would say the term recognition, recognizing any accounting item in your accounting records, means bringing it in your accounting records. This is done by passing an entry. You know, when you pass an entry, something gets recognized in your accounting records. So recognition could be recognition of income, recognition of expense, recognition of a gain, recognition of loss, recognition of asset, recognition of liability. Recognition of all of these will have their own specific criteria included in each Ind AS separately. Now, how and when to recognize income, how and when to recognize an expense, how and when to recognize a liability, how and when to recognize an asset, how and when to recognize a component of a gain or a loss is a matter of concern. Did you notice every time I used this term, I said how and when? When I say how, it means basically I am talking about the conditions which are required, and when I talk about conditions which are required to be fulfilled, that is how recognition should be made. Secondly, when recognition should be made. See, timing is also very important. For example, if you are dealing with any component of revenue, suppose I have made sale of goods, though sale of goods has nothing to do with this particular set of standards, but suppose I am talking about sale of goods. I have sold goods to my customer. Sale of goods is going to generate revenue for me without doubts, but it is going to be my revenue without doubts. I am going to recognize it someday, but which point I should recognize that revenue is of a concern. There, Ind AS 115 talks a lot about the timing and the manner of revenue recognition. So timing of revenue becomes very important. Exactly same way, many a times, suppose there is an obligation and the obligation is going to be settled, maybe not now but after 10 years, but obligation has arisen today. You will have to record that obligation, you will have to recognize that obligation today. So for example, if today I am issuing debentures, it is going to be a financial liability for the company. If I am a company issuing debentures, it is going to be a financial liability for the company. obviously I am going to recognize that financial liability. When should I recognize a liability? When? Recognition of liability has its own criteria. The moment there is a present obligation arising out of past event. So the moment I commit the counterparty, let's see, I am issuing debentures to you today. After 10 years from now, I will give you the redemption value of these debentures in cash. One obligation taken. During this span of 10 years, while these debentures would remain outstanding, every year I will make a coupon payment to you. At a specified coupon rate, I will be making coupon payments to you. These coupon payments, that redemption amount, this all is going to be what? This all is going to be my obligation. Obligation has arisen already. That is why we call it as a present obligation. Though the settlement, the payment, the outflow won't happen now, it will happen at a later date, but I have undertaken that obligation today. So what is the precondition for recognition of any liability in general? For any liability, the precondition is there should be a present obligation arising out of a past event. So when I say I am issuing debentures, the act of issuing debentures itself becomes an event which creates a present obligation upon the entity, and the entity will have to recognize that obligation today because it has become a present obligation. Now, so timing of that recognition is today. Timing is sorted. Now comes the next aspect, that conditions which were required for recognition of an obligation or recognition of a liability are fulfilled. Now the question arises, at what amount should I recognize this liability? See, the traditional accounting and the accounting that we are applying as per the IFRS requirements are completely different, right? So long back, when these Ind ASs were not into existence, when there was traditional way of recording all assets liabilities, we were sticking more to the historical cost concept and the nominal value concept. For example, if debentures are issued, at what price you are issuing debentures was never relevant. What was relevant always, what appeared in your balance sheet always, was the nominal value of those debentures. Why? Because the coupon payments have to be made at nominal value. So even if these debentures were redeemable at premium, premium would have been amortized on a time basis and gradually a separate obligation you would create. But now it is not like that. Now you are going to recognize each and every component of your liability based on the present value of your obligation. When I talk about present value, means time value of money has to be incorporated in literally each and every calculation. That comes the second aspect, that is measurement. Recognition, the first aspect. Measurement is the second aspect. Then comes presentation and disclosure. 99% students, even at final CA stage, final CMA stage, they come and tell me, sir, presentation and disclosure, they are one and the same. Both are same only. No, they are not same. They are generally mentioned together as presentation and disclosure. See, how should you present a particular component of asset or liability in your balance sheet? For example, I am talking about, say, employees compensation. Suppose you all are my employees, okay? I am a company, you all are my employees. For your retirements, I have planned some benefits for you. So these are post-employment benefits, means these benefits will be given to you on completion of your employment. Now what will happen? I have to gradually build up a fund which will help me to aid these all payments at later date. So one side what I'll do is I'll create an obligation for payment towards these employees, and another side I will deal with an asset management company where every month, every quarter, every year, depending upon my convenience of funding, I will set aside some amount by way of some kind of investments on a regular basis, so that I create a fund. That fund will be helping me to pay off all my obligations. Correct? Now, if we refer to Ind AS 19, that is talking about employee benefits, the standard says that one side you have created a liability towards your employees, that post-employment benefits that you have promised to them is your liability. Another side, to fund that liability, you are creating an asset by way of investing your money. So do not present that asset and liability separately in the balance sheet. You present it on a net basis. On a net basis means what? Generally it is assumed that your liability amount, suppose it is 20 lakhs, and to fund that liability you have created 17 lakhs of assets by way of investing your money by creating that fund. So your net liability, that would be rupees 3 lakhs, should be disclosed. Some exceptional cases when the amount of assets exceed the liability, then also the disclosure will be on a net basis, but that net amount, how to present that net amount, will again undergo some different type of measurement matters. Those things will be learning in detail under Ind AS 19 when we get started. But what will happen, the objective why I am discussing this standard at the early stage is because every other standard like that will require all the future obligations to be measured at present value. So that present value calculation, the presentation part, measurement part, everything should be crystal clear. Anyway, coming back to our point, I was talking about difference between presentation and disclosure, right? So when I am talking about difference between presentation and disclosure, presentation, I gave you an example right now that defined benefit obligation for the employee is a liability. The plan assets that you have created in the form of investments, it is an asset. Presentation wise, these both should be presented on a net basis. This is what we call as presentation. Where in the balance sheet it will appear is a disclosure. You understood my point? How you are presenting it to the public, to the readers of financial statement, that is presentation, and where it should appear, that is the disclosure. So if you focus on the word presentation and disclosure, disclosure typically means where it would appear, nothing more than that. So something may appear in the balance sheet, something may appear outside the balance sheet, something may appear as a matter of notes to accounts, something may appear in director's report, but those all are disclosures. An accounting item, how it will be reflected, not where it will be reflected, how the manner of reflection of an accounting item when it is coming in the financial statement, that we talk about as presentation. So 99% situations, nobody is going to ever ask you what is going to be difference between presentation and disclosure, but you all are going to be chartered accountants and cost accountants in near term. Why should you have lack of understanding with respect to even smallest of terms? Anyway, let us now talk about this particular standard. So the presentation, measurement and recognition criteria is all covered under Ind AS 32, Ind AS 109. Only the disclosure part is covered under Ind AS 107. So typically, if you break the whole component of the financial instrument, presentation is the major focus point of Ind AS 32. Recognition and measurement is the major focus point of Ind AS 109. And the only focus point of Ind AS 107 is disclosure. So that is why this is just one topic which you are going to learn in 3 segments, and I am telling you very clearly, I am not going to go into details of Ind AS 107 where I report the list of disclosures. It is something to be done by you yourself, and that doesn't mean that if my lectures and my videos are not containing discussion on that, then you are also not going to do. I am telling you right away at the beginning point, this will be your obligation to prepare it. In case you have any point of query, any point of doubt, you can always approach me. You know, you are connected with me by so many ways. My YouTube channel, you have my direct number, my office team number, you can just put forward your doubt and it will be clarified. But the point is, you are final level students, guys. You should not be dependent so much on any other person for your preparation. Something you have to prepare on your own, and where things can be done easily on your own, why should I put my time and energy behind that? I should better utilize the same for discussing something which is little complicated. So because we are going to focus on recognition, measurement and presentation primarily, we will be focusing on the initial two standards, that is Ind AS 32 and Ind AS 109. So we will begin our discussion with Ind AS 32 and then we will switch to Ind AS 109. However, we will not be completing entire Ind AS 32 and then go to Ind AS 109, because it is not possible. When I deal with a question which is asking you to pass accounting entries, passing accounting entries means recognition and measurement also will be involved. So I have to blend Ind AS 109 along with the discussion of Ind AS 32. So don't go standard wise, consider this as a consolidated heading for the entire topic that we are going to learn, and the topic is titled as financial instruments. Guys, what is most important, that the title that you are foreseeing over here, the title that you are observing over here, you should be clear with the meaning of that title. Financial instrument. What is the meaning of financial instrument? So Ind AS 32 has provided these simplest definitions, but these simplest definitions you should understand, that is more important. Now many students fail to understand those basic definitions and they end up making a big mess in this topic where they are not able to understand. You mark my words today, you focus on these definitions. Maybe while we are during the discussion over 6th or 7th lecture, there also I will show you what was the significance of the definitions that we discussed in the first class, without which you would not have developed any kind of understanding to reach to that level. These definitions are very, very important. Let it take little time for you to learn, little time for you to understand. Keep lot of patience. Financial reporting subject, if you want to master, you should have a lot of patience, because it's a big subject. If you think like everything you will grab in one go, it's not going to happen. Okay, I'll be telling you, countrywide, forget countrywide, worldwide, faculty members of financial reporting subject across the world, they took years of time for themselves to understand what the standards are really talking about. So obviously for students it is going to take time, and therefore some things which take time, let it take time, don't rush with that. So that is why in your live classes I have given a clear description about what all content you should attend with me on live basis, what all content you should just watch the recorded videos. So anyway, let us not mess around too much, let us get back to the track. Definition of financial instruments. Now what is a financial instrument? So let us focus on the definition, one line definition, but let us focus on that. A financial instrument is any contract. So what happens when I read a definition, I focus on each word, each phrase used in that statement, and you should do the same. And in other subjects like law, taxation, when you are learning, you know the significance of interpretation, right? Because interpreting the legal requirement wrongly can create a big mess over there. So I don't have to tell you what is the significance of interpretation. You should have good interpretational skills, and it is important to understand these definitions. So coming back to the definition, financial instrument is any contract. The moment I read this, I will not try to read the next word. I set my mind permanently, lifetime, that it has to be a contract. Means if there is no contract, a financial instrument can never emerge. Contract is the precondition. So a financial instrument is any contract that leads to a financial asset for one entity and financial liability or equity instrument for another. That means for one entity it will be a financial asset, for another entity it will be either a financial liability or an equity instrument. Let us take examples. Sometime back I told you that I am a company issuing debentures. Now debentures for me will become a financial liability. Why it will become financial liability? I have not talked about that honestly. As of now I am telling you it will be financial liability for me. You just understand it that way. After a while, when we step into the definition of financial liability, which right now you all might be thinking, oh, we know financial liability, but bet with me, you don't know the meaning of financial liability yet. It will take some time. Let me just reach that. I have tendency to create a little bit of suspense, so keep watching. Okay. Financial liability meaning I'll clarify in a while, but I am just giving an example. If I am a company issuing debentures, it will be a financial liability for me. If you are another entity who are buying these debentures or who are subscribing for these debentures, who are purchasing these debentures, you are investor, right? You are investing in these debentures. For you it will be a financial asset. So obvious logic is, when I am issuing debentures and you are buying these debentures, in your balance sheet it will appear as an asset, in my balance sheet it will appear as a liability. So here what I am talking about is a financial liability is different from generally a liability. So financial liability has a typical meaning, we will learn that. Financial asset also has a typical meaning, we will learn that. So we are right now not focusing on the definition of financial asset and liability, but the definition of financial instruments. Financial instrument is any contract that will give rise to a financial liability for one entity. In my case, when I am issuing these debentures, it is creating a financial liability for me, and financial asset for the other entity. For you it will be a financial asset. Imagine if I am not issuing debentures but coming up with an issue of equity shares. So I am issuing equity instrument and you are purchasing the same. You are now becoming an investor in the capacity of an equity shareholder. For you it continues to remain a financial asset, but for me it is not a financial liability. I will classify this as equity instrument of my company. So a financial instrument is any contract that will give rise to financial asset of one entity. For you it is financial asset whether I am issuing debentures or equity shares. To the extent you are investing into those shares or debentures, for you it is a financial asset. For the other counterparty, that is me, it could be either a financial liability in case of debentures or equity instruments in case I have issued equity shares. So this definition, if you are clear with this, you will understand that it is now putting your focus on three upcoming definitions. Which are those three upcoming definitions? Financial asset, financial liability and equity instruments. So let us do one thing. Here when I am asking you to write down, please do not be lazy. Please do not try to skip that writing work. See, these classes that I am providing, if some students have subscribed for these classes at a much later stage and they don't have time to write, I understand. I have given you a book titled as Resolve. Each and every definition, each and every explanation would be given in that book. But what happens, guys? It's your book, it is with you. What I am displaying over here will be there in that book also. But certain things I would emphasize that you should write. When you write, it just doesn't come into your notebook only. It gets settled in your mind. It will have its impact. That writing activity will leave an impact which will be showing its color not now but at later stage, because then when you sit and revise, even after 30 days, even after 40 days, with quick point you will be able to recollect the whole discussion. That is where revisions will become quick and you will be finding yourself at a better confident stage. So let us learn everything systematically, and learning systematically, see honestly, when I am coming across something, I always carry my rough pad and pen. I always note it down, always write. Because when I write, my understanding enhances like anything. So what applies to me applies to you as well. So honestly, I do not like lazy people. I am not a lazy person. I will not let you be lazy. So come on, write this particular definition of financial instrument. So we are first of all talking about Ind AS 32, which is titled as financial instruments. Within brackets, do you see presentation? That means the focus point of this standard is not too much towards recognition, measurement and disclosure. It is focusing more on the presentation part. So meaning of financial instrument, the definition that I have explained is appearing on the screen. I will just make the screen little bigger so that you can easily note down this definition. Once you write it down, we will move ahead. Alright friends, once you have completed writing this, let us now talk about those three connecting aspects, that is meaning of financial asset, meaning of financial liability, meaning of equity instrument. Let us talk about these one by one. So in this sequence of learning these three definitions, best thing would be to first understand what is a financial liability, because if you understand what is a financial liability first, then you will be able to understand financial asset meaning very clearly. Let us talk about financial liability. So a financial liability is a contractual obligation. Again the word contract came, right? A financial liability is a contractual obligation to deliver cash or other financial asset to another entity. Now focus on these words. A financial liability is a contractual obligation. So there has to be an obligation. First of all, nature of obligation could be contractual obligation, could be statutory obligation. For example, if I have some statutory payments due, like for example some income tax payments outstanding that I have to pay to the government of India, some amount of income taxes. Now that outstanding amount is my liability, but will it be a financial liability? Now here comes the difference between a financial liability and a non-financial liability. What is the financial liability? A financial liability is a contractual obligation. An obligation that arises because of statutory requirements cannot be a contractual obligation. Then it is called as statutory obligation, and statutory obligations cannot be financial liability. They are liabilities but not financial for a financial liability, for a financial asset, for an equity instrument, a contract must exist, because all these are examples of financial instrument, and financial instrument itself is a contract. So a contractual obligation to do what? A contractual obligation to deliver cash or other financial assets to another entity. That means to another entity I must deliver what? Either cash or another financial asset. If I have an obligation, for example, let's take examples where it won't be a kind of financial liability. For example, you are my customers, okay? Imagine you are a construction company, okay? Imagine you are a construction company and you happen to be my customer. I am manufacturer of bricks. I manufacture bricks and you are a construction company, so you are my customer because you will be buying bricks from me. Correct? You paid me an advance amount of say rupees 80,000 and I have promised you to deliver 4 trucks of bricks. What is my obligation? How can I, you already paid me in advance. How can I settle my obligation? To settle my obligation, I just have to deliver goods. I have to deliver goods. Goods are inventory for me. Inventory is not a financial asset. Because inventory is not a financial asset and delivering goods to you, I am able to fulfill my obligation. It is not a financial liability. Let us take much real example. You paid fees for attending my financial reporting classes. So you already paid fees. So now your obligation you have fulfilled. Now it is time for me to fulfill my obligation, correct? Now it is my turn, because you have paid fees in advance, correct? You have already paid fees in advance. Your obligation is fulfilled. Time for me to fulfill my obligation. How am I going to fulfill my obligation? Tell me. By taking your classes regularly or by providing you the recorded videos, depending on which mode you are joining with me. Okay. So what I have to give you could be either a service or could be a goods or some kind of recorded videos along with some textbooks. By delivering that, I can fulfill my obligation. So fulfillment of my obligation or settlement of my obligation is by delivery of neither cash nor any financial asset. Then I definitely have liability towards you. I have obligation towards you, but my obligation will never result into a financial liability, because definition of financial liability is what? It is a contractual obligation to deliver cash or other financial assets to another entity. That was the first clause of the definition. The first clause of the definition. Don't bother about writing it now. Let me first explain. I'll give you time. When I display the exact definition on the screen, you can write it down. But first you focus on this. So two clause. First clause, it is talking about a financial liability is a contractual obligation to deliver cash or other financial assets to another entity, or it could be a contractual obligation to exchange financial assets under conditions that have become potentially unfavorable to the entity. Sir, what? I'll repeat again, because this is generally the expression from students. Sir, what did you just say? I'll repeat again. A financial liability is a contractual obligation to exchange financial assets with another entity under conditions that are potentially unfavorable to the entity. My first warning, don't assume any meaning on your own. Do not assume any meaning on your own. You just wait for me to bring those examples so that you can clearly understand the meaning of what is the meaning of that particular clause. So once again I'll repeat, a financial liability is a contractual obligation to exchange financial assets with another entity under conditions that are potentially unfavorable to the entity. Let me come to the right time and I'll explain that. Next clause in this definition of financial liability talks about settlement in entity's own equity instrument, which itself is a big subject matter of our discussion. Settlement in entity's own equity instrument. So let us not try to mix up too many things at a time. Let us move forward step by step. I'll do one thing. I'll first make you write the clause that I have already explained, then the clause that is yet to be learnt. So let us do some writing work over here. Please take note of this particular matter. Example 1. These examples you need not write, these are given in your books. NJ Limited issues 9% debentures and X Limited acquires these debentures. Now this is a contract between two entities where NJ Limited is an issuer and X Limited is the holder of a debt instrument, which is a financial instrument. This contract creates financial liability for NJ Limited and financial asset for X Limited. As I told you, don't write this particular example. You can check your books. The same example would be given over there. Examples we are not going to write unless those are not appearing in your textbooks. So let us move ahead. I'm sure you have understood this example. The next example is also something that I have discussed with you already. NJ Limited issues equity shares and X Limited acquires these equity shares. Now this is a contract between two entities where NJ Limited is an issuer and X Limited is the holder of an equity instrument, which is a financial instrument. This contract creates an equity instrument for NJ Limited, but it creates a financial asset for X Limited. Because it is creating financial asset of one entity and an equity instrument of the other, it is definitely a financial instrument. Moving forward, this thing I would want you to write in your notebooks. Financial instruments as the main heading comprising of three segments: financial assets, financial liabilities and equity instrument. Just write this exactly in this way. Write it quickly and then I take you ahead. Alright, I am sure you have completed writing these headings. Let us move ahead and we write the meaning of financial liability. This is something that you must write in your notebooks. Even though it is there in your textbook, you should not skip writing this part. A financial liability is a contractual obligation to deliver cash or other financial assets. A financial liability is a contractual obligation to exchange financial assets with another entity under conditions that are potentially unfavorable to the entity. A financial liability is a contract that can be settled by delivering a variable number of entities' own equity instruments. And lastly, it says a financial liability is a contract that can be settled by entities' own equity instrument other than for delivery of fixed number of equity instruments for fixed amount of cash. Now, out of these 4 points displayed over here, which conveys the entire meaning of financial liability, I have explained you only this first point. I haven't explained you any of these 3 points. So don't bother about understanding of these 3 points. You please carefully note down this whole content. Writing this is important, and as I asked you, keep a lot of patience while learning this. Once you write it up, I'll explain the whole thing in detail. Alright friends, once you have completed writing this whole thing, let me take you ahead and let me make you write an example, a very important example. Let us first write that example to understand the content ahead. In this example, X Limited's share is currently priced at rupees 560 per share. Mr. A enters into a contract with Mr. B whereby after 3 months, Mr. B will sell 5,000 equity shares of X Limited at price of rupees 560 per share. As at the balance sheet date, the market price of X Limited's equity share is rupees 600 per share. Evaluate the impact of this contract for both the parties at the balance sheet date. So first do one thing, first write up this example and then I'll explain you the whole thing in detail. Alright friends, you have written this example, so let us now try to understand the same. If you carefully read what is given over here, it says X Limited's share is currently priced at rupees 560 per share. So the current market price of the share is 560. Mr. A enters into a contract with Mr. B whereby after 3 months Mr. B will sell 5,000 equity shares of X Limited at a price of rupees 560 per share. So whatever be the current market price, at the same price B has agreed to sell, but not today, after 3 months. Now first thing that I get to know the moment I read this second line in this example, the first thing I get to know, this is typically a perfect example of a forward contract. Why a forward contract? You are agreeing to buy or sell something today, correct? You are agreeing to buy or sell something today at a price that is fixed today, but the settlement will happen at a future date, at a specified future date. This fits into the definition of a forward contract. So after 3 months, you are going to exchange shares for cash, correct? And at the balance sheet date, what is happening? The market price of this equity share has gone to rupees 600. Now A has agreed to buy and B has agreed to sell. If I ask you a question, can you guess who would have been at a beneficial stage at the balance sheet date when the market price of the share has gone to 600? Those who are attending live, can you just type in your answer? Who is at a benefit? Who is at a loss? So first you tell me who is at a benefit. Of course, you all are correct that A has an advantage. You can easily understand A has the advantage. Why? Because the contract price for purchase is 560 and the prevailing market price is 600. So at the balance sheet date, how A will perceive this, that he has a right to buy these shares at 560 where the prevailing market price in the open market is 600. If A has this as an advantage, now what advantage do you find? You have a contractual right to exchange financial asset with another entity. From A's viewpoint, I am not talking this as a contractual obligation. Do you think while conveying this to you, what would A tell you? If A is your friend, how would A convey this to you? Will A convey to you that, you know, my friend, I have an obligation that a share which is priced at 600, I have an obligation to buy it at 560. You will laugh at A that how can this be an obligation? It's a benefit for you, right? So counterparty A will talk about this as not an obligation but a right. Right to exchange financial asset. Why exchanging financial asset is coming into picture? A will pay cash and will receive the shares. Cash is a financial asset. Equity shares of X Limited is also a financial asset. So you are entering into a contract to exchange financial asset. Now for one of the party, that is A in this example, the contract has turned to be potentially favorable. The contract has turned to be potentially favorable for A. But the same contract has turned to be potentially unfavorable for B. Correct? Now, if you are not A's friend but B's friend at the balance sheet date, do you think B would be conveying this to you happily? Of course not. Of course not. Can you imagine if B is your friend, how would B convey this to you? That, you know, yaar, I have an obligation to sell a share at 560, market price of which is 600. Even though the market price is 600, but I have a compulsion to sell it at 560. This would be the message given by your friend B to you. So B has a obligation. So B will call this as a contractual obligation, where A would call this as a contractual right. You know what I am doing? As I told you, along with understanding the definition of financial liability, you would parallelly start understanding the definition of financial asset, because here the clause talks about this way: a financial liability is a contractual obligation to exchange financial asset with another entity under conditions that are potentially unfavorable. So same wordings used in the opposite meaning over there, it conveys a financial asset is a contractual right to exchange financial assets with another entity under conditions that are potentially favorable to the entity. you people are understanding these definitions, right? And as I have asked you to keep lot of patience, because I'll be talking about this a lot, don't get frustrated and stop the class, correct? You need time to understand this, and that is why I am also taking entire time available in this universe, as if we have no other business but just to understand meaning of financial asset and financial liability. You know, as if my whole objective of life at this point is nothing other than talking about, explaining what is financial asset, what is financial liability. Anything other than that in the universe doesn't affect me. When you study with this kind of intensity, how will you not be clear with the matter? You will get that kind of clarity which we call as a permanent learning, lifetime learning. Once you learn, permanently done, correct? When, see, today you don't have to think. If I ask you how much is 3 into 6, by the way, how much is 3 into 6? See, you are laughing at me, that come on sir, are you joking with us? What kind of question you are asking? You know, the answer is flashing in your mind instantly, 18. But look at, recall the time when during your childhood, when you were learning multiplication for the first time, your teacher would have taken so much of pain to make you understand that how do you multiply 3 and 6 and how does it become 18. The idea is, what you have learned that time has become a permanent learning of yours. Even if I wake you at midnight 3 a.m. and ask you what is your name, will you give me a wrong answer? You won't give me a wrong answer. You know why? Because you don't have to remember your name, you know your name. This is difference between remembering and knowing. So, you know, when I am discussing these concepts with you, I don't have to read the book again and again, because I have read it so many times that now I don't have to take pains to remember it. I know it. Prepare it so many times that you also know it, and once you know it, it is an achievement for lifetime. Anyway, so now what is going to happen? At the balance sheet date, A will record this difference as a financial asset and B will record this as a financial liability. One more thing I'll tell you, you know, have you ever thought of derivatives? And derivatives are generally settled in cash. That means actual buying and selling don't happen in derivatives. If you have learned financial management already, that is strategic financial management, you would have known how derivative markets function. But even at final stage, you all should have this understanding very clear. I don't have to explain you that derivative markets, where contracts would be in the form of futures and options, even those are contracts where you have obligation or right to exchange financial assets. But there the settlement doesn't happen by way of actual physical delivery of buying and selling. The settlement happens in cash. That is where your objective is speculative. So let us do one thing, add some more flavors to this example and then extract some considerable meaning out of this. So what I am showing over here, just try to understand the same. With respect to the same example, Mr. A, he says that X Limited's share quoted rupees 560 now. After 3 months, price will rise. If this is what is expected by Mr. A, we would say in financial terms that Mr. A has bullish sentiments. Similarly, on the other side, the other party, Mr. B, says no chance. After 3 months, the price will fall. So Mr. B has bearish sentiments. So you understand what is bullish and bearish sentiments? An expectation that the price will rise is what we call as bullish sentiment. An expectation that the price will fall is what we call as bearish sentiment. So current market price is 560. A believes that the price will rise. B believes that the price will fall. suppose as per B's sentiment, price is going to drop to 500. That is why B is very happy in selling the share at 560 after 3 months. A is happy in buying the share at 560 after 3 months because A believes that after 5 months the price will rise. Correct? Moving forward in this example, once you understand the perspective of the two parties, A having bullish sentiments, B having bearish sentiments, look at what they negotiate ahead. A says, I agree to buy 500 shares of X Limited at 560 each after 3 months. B says, I agree to sell 500 shares of X Limited at 560 after 3 months. And then Mr. A says, let us make a speculative deal, let us sign a contract, and B confirms that we shall square up the price difference in cash. So they sign a contract and this contract becomes a derivative. So this is a contract. At the balance sheet date, the price of X Limited's share is found to be rupees 600. Now, can you guess what will be gain made by A and loss incurred by B? Because we already talked about one thing, that A will be at a gain, B will be at a loss. Can you compute how much will be the gain to A and loss to B? So idea is 560 is the contracted price. Prevailing market price is how much? Prevailing market price is 600 per share. Per share there is a difference of rupees 40. With that difference of 40, A is at an advantage. So A will consider this as a financial asset, B will consider this as a financial liability. So basically what I would want you to do as a follow up of that example, you may write that this is a contract and at the balance sheet date the price of share of X Limited is found to be 600. A gains rupees 20,000, B loses rupees 20,000. How we got 20,000? It was simply difference between 600 and 560 multiplied to 500 shares, and this will give you the overall difference of 20,000. So please write these 3 lines quickly and then I take you ahead. Moving forward, this contract is a financial liability for Mr. B because it creates a contractual obligation for Mr. B to exchange equity shares of X Limited with cash, but under conditions that have become potentially unfavorable to Mr. B. The same contract is a financial asset for Mr. A because it creates a contractual obligation for Mr. A to exchange equity shares of X Limited with cash, but under conditions that have become potentially favorable to Mr. A. I want you people to write these explanatory paragraphs and then I take you ahead. Alright friends, you must have finished writing these explanations. Over here I can read in the chat box one of the doubt mentioned by a student. The doubt goes this way: sir, one doubt, for B it is an opportunity loss and not an actual loss. Does that need to be presented? Now for B, he says that it is an opportunity loss, then why are you presenting in balance sheet? Now let me tell you, this is where the relevance of IFRS comes into picture. See, what is happening in reality, you need to put it in your accounting records. I don't know whether you have ever taken position in any futures contract, or if you haven't done it yourself, have you at least known about that? There is a concept called mark to market margin, something called marking to market. So for example, if this was a futures contract, both the parties suppose they would have deposited rupees 50,000 each. Suppose both of them would have deposited 50,000 each. A's deposit with the exchange 50,000, B's deposit with the exchange 50,000. At the balance sheet date, derivative market would have understood this, that at this date the market price has risen to 600, A has made a gain of 20,000, B has incurred a loss of 20,000. Obviously, what will happen? A will be having increase in his margin by that difference of 20,000, B will be having reduction in his margin by that 20,000. I don't know whether you are aware of these kind of settlements made by derivative market, but this is what we call as mark to market margins and settlements accordingly. So if these kind of settlements, they are actually adding money to your account and drawing money from your account, how can you even think of this as an opportunity loss? It is indeed a real loss to you. I hope you people are understanding my point, that today how market actually functions, what is happening in reality, we are showing that there is no imaginary thing that we will ever record in our accounting books. That is why the definition is talking about recognizing of a contractual obligation or a contractual right in the form of a financial liability or a financial asset, as the case may be. So I believe the student who has put forward this doubt is clear. I'll be happy if you can confirm that you are clear with the same. If you are clear with that, that's great. And let us do one thing. Let us move forward and write something more. So now that you have got clarity of the second clause, okay, let us write a few examples of financial liability. Creditors and bank overdraft are examples of financial liability. Bills payable and debt instruments issued, short term and long term borrowings, a promissory note to deliver cash or other financial assets. A promissory note to deliver a truck of bricks to a construction company is not a financial liability. I remember I gave you the same example some time back. Income tax payable is not a financial liability because it is not a contractual obligation to pay tax, it is a statutory obligation. So I would want you people to write down these contents and then I take you ahead. Alright friends, I am sure you have completed writing these examples. Let us move ahead and now talk about meaning of financial assets. So the first thing that I would want you people to write down, where no further explanation will be needed, the first line, cash is a financial asset. It includes bank balance, of course, equity instrument of another entity. If you are holding equity instrument of another entity, it is your financial asset. A financial asset is a contractual right to receive cash or other financial assets from another entity. A contractual right to exchange financial asset with another entity under conditions that are potentially favorable to the entity. A contract that can be settled only by receiving entity's own equity instruments other than for fixed number of shares and for fixed amount. So if you focus on this particular point, I have explained to you this point already through an example, and if I focus on the last point over here, this point we have yet to understand, correct? So other than this last point, every other point will be easily understandable. So please write the whole thing quickly, and what is not understood by now, I will definitely explain it in a while, but first you finish writing this quickly. Alright friends, once you have completed writing the meaning of financial assets, let us move ahead and let us write some notes about presentation given in paragraph 15 of Ind AS 32. the issuer of a financial instrument shall classify the instrument or its component parts on initial recognition as a financial liability, a financial asset, or an equity instrument in accordance with the substance of the contractual agreement, or you can say contractual arrangement, and the definitions of financial liability, financial asset, and equity instrument. Please do one thing, please write this important content and then I'll begin with the explanation. Alright friends, once you have completed writing this whole thing, let me explain what is the content of this para 15. Please try to follow this. Para 15 of Ind AS 32, which talks about presentation typically, it says if there is any financial instrument, it will be either of these three, a financial liability or a financial asset or an equity instrument, or even a component of that could be recognized as a financial liability or equity instrument. That means at later stages, it is not the whole instrument that will be put as a financial liability or as equity instrument. Maybe part of that whole instrument, one component of that is identified as a financial liability, another component of that is identified as equity instrument. That is also possible. So what you need to understand is this classification that you are making among these three categories of financial instruments, that has to be based on substance of the contractual arrangement. It is about the substance of the contractual arrangement. See, 100 times you would have learnt in accounting standards the concept of substance over form, means legal form is not important, it is the substance of the arrangement which is important, and that is where substance will play a tremendous role over here, a very important role, and we are going to see this immediately when we start talking about that last clause which is pending in our discussion, that is all about the settlement in entity's own equity instrument. So few things, that the whole instrument or even the component could be identified as this. So my point of concern, where I would suggest you to underline the keyword over here, is its component parts. Underline these words, its component parts. That means at later stage you are going to come across instrument which will be having part characteristic of a financial liability, part characteristic of an equity instrument. We will call that as compound financial instrument. We will call that as compound financial instrument. So the classification into financial liability or equity instrument may be in entirety or maybe with respect to a component of that instrument and not the whole instrument. So either case you should be able to do that, and to do this what is primarily required is the application of substance. Substance is definitely more important over here. Now let me take you ahead with some more writing work. Definition of equity instrument. Now basically if I talk about definition of equity instrument, I would say any instrument that provides the holder the residuary interest in the entity. I'll give you that thing to write, don't bother about writing, first you understand. Any instrument which again emerges by a contract, don't forget, even equity instrument will be a contractual arrangement. A contractual arrangement whereby the holder of the instrument will have residuary interest in the assets of the entity after payment of all liability. That is the definition of equity, right? So simplest definition of equity is what? A contract whereby the holder participates in what? The residuary interest, and residuary interest in a company where in the assets of the company you are participating as a residuary interest, and that will be after payment of all the liabilities. Now here para 15 is what we are talking about. The connecting paragraph, para 16, when I deal with that paragraph, definitely I'll explain that in detail, but it talks about a different kind of equity instrument which are puttable instruments. So I don't want to go into that mess right now. Para 16 talks about puttable instruments. First of all, in Indian scenario, it is irrelevant completely, because I don't find any Indian company by far ever issuing a puttable equity instrument, and neither it is going to happen in the future. So the whole paragraph 16 in Indian context, there may not be any relevance of that, but because it is there in your syllabus, because it is given in the books, we cannot ignore it, we have to prepare it, but it is not of too much importance in real life definitely, and that is why from examination viewpoint also it may not carry too much of weightage. But as we want to have exhaustive preparation, we will not leave it. So let me do one thing, I'll just give you a paragraph about puttable instruments right now. Just note it down, don't bother about its meaning, you just be careful about the first term that you are writing, that is meaning of equity instrument should be clear. The next follow up paragraph, if it is not clear as of now, don't bother about it, as I said. So definition of equity instruments I have explained, definition of puttable instrument you just note it down, and I will be explaining this when the right time comes. So let me give you this opportunity to note down this entire definition, and then we move ahead. I'm sure you have completed writing this whole thing. Now time for us to take up some questions. So let us deal with the initial set of questions. Question number 1, let us read this question. NJ Limited enters into a contract with A Limited whereby after 3 months it will sell 5,000 equity shares of X Limited at price of rupees 68 per share. As at the balance sheet date, the market price of X Limited's equity share is rupees 75 per share. Identify whether this contract is a financial asset or a financial liability for NJ Limited and A Limited. So friends, let us first understand what is informed in the question. There are two companies, NJ Limited and A Limited, which have entered into contract to exchange financial assets, correct? What NJ Limited would give away or sell is 5,000 equity shares of X Limited, and against a defined price of rupees 68 per share. Now what has happened? NJ Limited has agreed to sell, correct, these shares at rupees 68, whereas at the balance sheet date the share price is rupees 75. Now the point is very clear, something having price of 75 in the market, NJ Limited has agreed to sell it at a low price, correct? So it is basically a loss to NJ Limited, and if this contract is to be settled in cash, it will be NJ Limited which will have to pay off this loss to the counterparty A Limited. So we can say that this contract has turned potentially unfavorable to NJ Limited and potentially favorable to the counterparty A Limited. So as per the definitions, we can say a contract that creates a contractual obligation to exchange financial asset with another entity under conditions that are potentially unfavorable to the entity will create a financial liability. So yes, we are definitely talking about NJ Limited. For NJ Limited, this contract has finally turned to be potentially unfavorable, whereas for A Limited it has turned to be potentially favorable. So this contract is creating a contractual obligation on NJ Limited, whereas a contractual right for A Limited to make this exchange. Finally, what you would do is 68 and 75 difference is rupees 7 per share multiplied by 5,000. that will be rupees 35,000. So NJ Limited will recognize a financial liability of rupees 35,000, whereas A Limited will recognize a financial asset of rupees 35,000. So let us see how to present the solution. In your solution you would write, this contract is a financial liability for NJ Limited because it creates a contractual obligation for NJ Limited to exchange equity shares of X Limited with another entity, that is A Limited, against cash under conditions that have become potentially unfavorable to NJ Limited. On the other side, the same contract is a financial assets for A Limited because it creates a contractual right for A Limited to exchange equity shares of X Limited with another entity, that is NJ Limited, under conditions that have become potentially favorable to A Limited. So friends, do one thing, write up this much and then I'll show you how to write the conclusion as well. Alright friends, you would have finished writing this whole thing. Let us move ahead and write up the concluding part. We will say that NJ Limited will recognize a financial liability of rupees 75 minus rupees 68, that difference multiplied by number of shares, that is 5,000 shares, and that would be a financial liability of rupees 35,000. So obviously what will happen is A Limited will recognize a financial asset of rupees 35,000. Write up this whole thing and that will be end of the answer. Alright friends, if you have completed writing this entire solution, time for us to move ahead and write up the next heading, settlement in entity's own equity instrument. So this is something really interesting, and what exactly it is talking about? It is talking about the last clause of the definition of financial asset as well as financial liability. Very important. So there are certain contracts that can be settled by issue of equity instruments of the own entity. A lot of important matters relating over here. So what I do is, I'll explain this whole thing to you by taking an example. So first thing what you do is you write up this heading in your notebooks, settlement in entity's own equity instruments. Once you have written this heading, I am going to display an example over here which you need not write, just try to understand. Please try to understand this example, very important example, 100% focus over here. So there is a company NJ Limited, there is another company A Limited. Now there is a transaction between these two companies whereby NJ Limited acquires a property from A Limited. NJ Limited acquires a property from A Limited. Now when it comes to recognition of this transaction, so NJ Limited has acquired a property from A Limited and the payment is not yet settled. Of course, settlement is pending, and let us assume that the contract price for purchase of this property, that means the consideration for purchase of this property, say it is rupees 50 lakhs. So what accounting entry do you think NJ Limited will pass in its books for recording this transaction? The obvious answer that you would say in the books of NJ Limited will be property account debit 50 lakhs to A Limited's account. So one side NJ Limited has recorded an asset of 50 lakhs, another side it has recorded a liability of 50 lakhs. Correct? No? Correct? Now suppose NJ Limited makes a deal with A Limited that, boss, you do one thing, you accept the settlement not in cash, we will give you this settlement happening after 6 months, and please accept the settlement in the form of our equity shares instead of taking cash. So NJ Limited is trying to put forward two propositions parallelly. Number one, let the settlement not happen today. It has taken time of 6 months for the settlement. So assume that today on the date of this transaction, it is 1st of January. So the settlement will happen on 30th of June. So first of all, it has agreed for a deferred settlement, fact number 1. Second thing, it has attempted to convince A Limited that instead of taking cash, first of all, settlement will happen after 6 months, and then instead of taking cash, you take equity shares of NJ Limited worth rupees 50 lakhs. And suppose A Limited agrees to that arrangement. A Limited agrees to that arrangement. Now, NJ Limited did not issue equity shares on 1st January. Shares will be issued on 30th of June, that is a settlement date. But between these two dates, that is between the date of purchase of property, that is what we call as 1st of January, and the date of settlement, that is 30th of June, in between these two dates, there will be a reporting date, that is 31st March, the balance sheet date, the reporting date. Now, what is the nature of this arrangement by that date? So, that date for NJ Limited, there is a contract where there is an obligation to settle 50 lakhs, but such contract will be settled in only one way, that is by issuing equity shares by NJ Limited. Means it is an example of a contract that can be settled by entity's own equity instrument. I repeat, it is a contract that can be settled in entity's own equity instrument. So, try understanding one thing in this example, what I am showing you further, and as I said, you do not have to write this example, you just try to understand the facts over here. So, they have agreed that consideration of rupees 50 lakhs to be settled by issuing equity shares in NJ Limited after 6 months from now. The question then arises is, how many shares shall be issued? So, at present the market price of shares in NJ Limited is rupees 500. At current market price of rupees 500, the amount of 50 lakhs can be settled by issuing 10,000 equity shares in NJ Limited. 10,000 equity shares in NJ Limited. How did we obtain? If you take 50 lakhs, 50 lakhs is the amount to be settled, and the mode of settlement will be equity shares of NJ Limited, and each equity share of NJ Limited has a current market price of rupees 500 only. So, how many shares you will issue for the purpose of this settlement? It will be 50 lakhs divided by 500, and that would give you 10,000 equity shares in NJ Limited. So, this is the next point of proposition between the two companies, that you take 10,000 equity shares. Now, read this line, at present the market price of shares in NJ Limited is 500. Suppose A Limited agrees for 10,000 shares of NJ Limited in full settlement. What will be the impact? What is the market price of NJ Limited's equity share today? Do you think the same price will remain in 6 months' time? This is the point. So, what is the point of concern? You need to understand the question involved in this case study. Shares have not been issued yet. Shares will be issued when? Shares will be issued when? On 30th of June. But in between the contract date, that is the date on which the asset was acquired and this contract was made, and the settlement date, there will be a reporting date that will be 31st of March. As at 31st March, no equity shares have been issued, but NJ Limited has to disclose the settlement pending towards A Limited, because A Limited was originally recorded as a financial liability. Now, whether A Limited will continue to be recorded as a financial liability at the balance sheet date, or will it be reported as equity instruments? See, after 30th June, this question will become irrelevant. I mean, after 30th June means after settlement by issue of equity shares, I won't ask you this question, because then it is obvious you have already issued equity shares. That time A Limited would have become your equity shareholder, correct? Then this 50 lakhs will be part of your equity instrument, 100% guarantee. So I am having no questions. After 30th June, this question itself becomes irrelevant. The concern right now is that what if I am at 31st March? At 31st March, the amount that is due towards A Limited, 50 lakhs, for NJ Limited, is it a financial liability or is it an equity instrument? How would you classify that? That is the concern. Take your time, think, and each one of you who is attending the class right now live, I want you to give me your answers in the comment box. That is, what do you think would happen on 31st March? How will NJ Limited perceive this amount payable to A Limited? Is it to be recognized as a liability, that is a financial liability, or is it to be recognized as equity instrument? Come on. Any one answer. Either FL, that is financial liability, or equity. One word answer. What will be the status? How will you classify this obligation at the balance sheet date? Okay, I am getting your answers. Some people are saying financial liability, and some people are even giving answers with reasons. Pawan says financial liability because shares have not been issued as of now. So simple common sense is what he is applying. Currently no equity shares have been issued. Until issued, it is a liability. Some people on the other side are mentioning this as equity. Now, what is the real answer? I am going to talk about that. But first you tell me one thing. The classification has to be made in substance. That means it is the substance of the arrangement that you have to consider. Therefore, please pay attention over this point of discussion. How many shares NJ Limited has offered? How many shares NJ Limited has offered? 10,000 shares, which are currently priced at 500. Now please understand, I am NJ Limited, you are A Limited. Okay. Today we agreed that you will accept 10,000 equity shares from me. What if the price of this share rises from 500 per share to 800 per share? The price of this share rises from 500 per share to 800 per share. You will still receive 10,000 shares because that is the arrangement. You will receive 10,000 shares. But the day you receive 10,000 shares, the value that you received would not be 50 lakhs. Value that you received will be 80 lakhs. Do you agree with me or not? Okay. You are A Limited in this example. You are A Limited in this example, but I have plenty of other equity shareholders who are already my shareholders, They are holding my shares at a current market price of 500. 500 value is becoming 800 for them over these 3 months time. You know, when I say 3 months time, are you understanding from which date to which date I am talking about? 3 months. From 1st January to 31st March reporting date, 3 months time. In this 3 months time, market price of 500 rises to 800. My existing equity shareholders will be benefited. Along with them, you who is A Limited in this example, you are A Limited in this example, you will be having equal benefit, just like my existing shareholder. That means counterparty for NJ Limited, the counterparty is A Limited. How is counterparty benefited with this arrangement? Counterparty is being benefited exactly in the same way as my all other equity shareholders. So boss, in that case, you are already participating as a beneficiary, just like my equity shareholders, at the current date itself. You are already participating in the equal capacity, just like my equity shareholders already at present. Now you tell me, fundamentally, if I look into the substance of the arrangement, not the legal form, but the substance of the arrangement, aren't you benefited in the same way as my existing shareholders? Answer is yes, because you are benefited in the same way as my existing shareholders. What you are for me? What you are for me? Are you my liability or are you my equity? The answer is you are my equity. See, if you use your brains, you don't have to go to the language of the standard also. Standard has simplified this by putting clear definitions. But if you use your common sense, you will get to know that in substance, this cannot be a liability, this is equity. Now, let me turn up the scenario. Suppose this company in this example, A Limited, actually you are A Limited in this example, okay. Suppose you say that no, I don't want fixed number of shares. What if the price of the share drops? Suppose price of the share drops from 500 per share to 400 per share, then what will happen? The value that you will receive in this settlement will be how much? Not 50 lakhs, but just 40 lakhs. And suppose you don't want to participate in that. You would say, boss, I don't want fixed number of shares. I am ready to accept settlement in your equity shares, but I want my 50 lakhs. The day you issue shares, that day's market price, whatever it is, based on that you give me the number of shares. So let me pick the calculator. 50 lakhs of settlement which is outstanding. If I divide by, say, future market price of 400 per share, if the market price drops to 400, if I divide it by 400, number of shares that I would have to issue to you will be 12,500. Agreed? It will be 12,500. So you are not agreeing for fixed number of shares. In that case, you will start participating in the company in the capacity of equity not before 30th June, because till 30th June you are behaving as an outside party, because then if the market price of NJ Limited's share drop, you don't want to be affected. If the market price rises, you don't want to be affected for that benefit also. You are not going to get affected till I issue those shares to you. That means if you don't agree for a fixed number of shares and you go for variable number of shares, where the number of shares to be issued will depend upon the market price of the share prevailing on the date when settlement takes place, use your brains. That time you don't become or you don't behave like equity shareholders of my company till 30th of June. Till 30th June you are behaving like outsiders. Till 30th June you are behaving like outsiders. So simple common sense prevails. Simple common sense says that you are not yet my equity shareholder. Correct? As of 31st March, if your benefit is in parity with the benefit of my equity shareholders, correct, then I will classify you as equity. If your benefit is not in parity with my equity shareholders who are existing equity shareholders, I will not classify you as equity, then I have to classify you as financial liability. Is something going into your head or not? Now let me take you to the language of the question. Some time back Nivedita was asking me, sir, you did not explain that point. So I told you, keep patience, I am coming to that point. So the lines that you have written in your notes, the last paragraph of financial go to the definition of financial liability right away. Go to the definition of financial liability. Here is the definition of financial liability, the meaning of financial liability. Look at these two clauses. I have already explained you these two clauses earlier. Am I right? No doubts about that, right? What was yet to be learned? Tell me. third and fourth clause? Third and fourth clause, look at this third clause. This third clause, it says a financial liability is a contract that can be settled by delivering a variable number of entities owning. The moment the number of shares to be issued are variable number, it will not be an equity instrument, because that time the counterparty will not participate in the benefit exactly like equity shareholders. That time it will be treated as an outside party or as a financial liability. That is why financial liability definition includes this. Another clause. A financial liability is a contract that can be settled by entities' own equity instrument other than for delivery of fixed number of equity shares for fixed amount of cash. So if it is fixed number of equity shares for fixed amount of cash, then it will be equity. In all other cases, it will be a financial liability. That is conveyed in this definition, but you will not be able to understand this definition just the way it is appearing. That is where I have asked you to once again refer to this example. Please once again refer to this example. Let me bring you to that example once again. Recall this example. NJ Limited purchased a property from A Limited, and A Limited has agreed to accept the settlement of rupees 50 lakhs by issuing equity shares in NJ Limited after 6 months from now. Okay, and currently the market price is 500, and based on the current market price of 500, the equivalent number of shares that you should consider for settlement of 50 lakhs will be 10,000 shares. Now the question is, if A Limited agrees for 10,000 shares, fixed number of shares for a fixed amount, that means it is ready to accept 10,000 shares for a settlement of fixed amount, 50 lakhs. 50 lakhs is a fixed amount. If it agrees for a fixed number of shares, it becomes equity right away. Then at 31st March, you will treat A Limited as your equity instrument. If it agrees for variable number of shares, not fixed number of shares, if it simply says, boss, I want to settle, I want the settlement of my 50 lakhs which is outstanding, so you settle my 50 lakhs. If that is the concern, it is behaving like an outsider, and that time, because the number of shares will be variable number of shares, it will require NJ Limited to treat it as a financial liability. Before I take you ahead, I want responses from your side, that is this thing clearly drilled into your minds or not? Super, very good, very good. So I believe with your responses I can see all of you are crystal clear with this. So now let me put an extension in this example. Here I would say, however, A Limited doesn't agree for fixed number of shares. A Limited demands that the number of shares to be issued shall depend upon the prevailing market price, and the prevailing market price on the date of issue for settlement of its outstanding balance of 50 lakhs. The moment you come across this extended part in the example, now what will be your response to this? As on 31st March, NJ Limited will treat A Limited as what? A financial liability or equity? The obvious answer now is financial liability. For settlement of that fixed amount of 50 lakhs, if A Limited accepts fixed number of shares, equity. If it does not accept fixed number of shares and wants the settlement based on the market price on the date of issue, it will make the number of shares to be issued as variable number of shares. That time it will become a financial liability for NJ Limited. See, we are not talking from the viewpoint of A Limited. The reporting entity in this example is not A Limited. Reporting entity in this example is NJ Limited. So for A Limited, it is definitely a financial asset without doubts, For A Limited, it is a financial asset, correct? Whether it is receiving fixed number of shares or variable number of shares, for A Limited, it is a financial asset. The concern is for NJ Limited, how will you classify whether a financial liability or an equity instrument? So here now I believe we are clear with this. So what we do is, instead of noting down this example, because I have stopped you, don't write down this example, we put forward this whole thing in the form of a question and answer, and you better note it down. And this is nothing but question number 2 in your textbook. Please refer your textbook, question number 2. Here it is. I'll read out that question for you and we will write up the answer for the same. On 1/1/2020, NJ Limited acquires a property from A Limited worth rupees 50 lakhs. The amount of consideration, that is rupees 50 lakhs, shall be settled by issue of equity shares of NJ Limited on 30th June 2020. The number of shares to be issued shall depend upon the prevailing market price on the date of issue for settlement of rupees 50 lakhs. The moment you read this line now, you have absolutely no confusion. You will know that until the shares are issued, A Limited will be treated as if it is a financial liability for NJ Limited, correct? So they are asking, identify whether on 31/3/2020 this contract is an equity instrument or a financial liability for NJ Limited. So this is the question, and we have read, this is nothing but the reflection of the same example. So we just need to formally write down the answer for this. So in your answer you would first write, this is the case of a contract that can be settled in entity's own equity instrument. As per the terms of the contract, the number of shares to be issued by NJ Limited is variable and depends upon the market price of these shares as on the date of issue. On the date of settlement, sufficient number of shares will be issued by NJ Limited to settle a fixed amount of obligation of rupees 50 lakhs. So obligation to be settled is fixed amount, but the number of shares to be issued is variable. So before I conclude this example, quickly write up this whole thing as part of your answer to question number 2. Write this quickly and then I take you ahead. Alright friends, if you have written this much, let us move ahead and continue writing further in that solution. As per the definition of financial liability, a contract that can be settled by issue of variable number of shares to settle a fixed amount shall be treated as financial liability as per Ind AS 32. So the conclusion is, as on 31st March 2020, NJ Limited should classify and record this contract under financial liability. So write up this explanation and it will be end of the answer. Alright friends, once you have completed writing this, let us revisit that situation. NJ Limited and B Limited are the two entities, and NJ Limited acquires a property from B Limited. Exactly similar situation, consideration of rupees 50 lakhs to be settled by issuing equity shares in NJ Limited after 6 months from now. At the present market price of shares of NJ Limited, which is rupees 500, the number of shares that you will issue for settlement of this will be 10,000 equity shares in NJ Limited. B Limited agrees for fixed number of shares, that is 10,000 shares. So now with this modification in this example, where B Limited is agreeing for fixed number of shares in the settlement, amount to be settled is fixed, and B Limited has agreed to accept fixed number of shares for settlement. So we know the answer now. These shares will be issued on 30th June, correct? But at the balance sheet date, the shares are not into existence. But because the substance of the arrangement makes the counterparty A Limited having parity with the existing equity shareholders, substance over form. What a perfect example of substance over form that we have seen over here, correct? So you will be one more recommendation that I have, when you write this answer, you separately, for your own understanding in your notebook, you mark it and write it as good example of substance over form. So I'm sure you understood that this thing what we are talking about, it will give rise to an equity instrument at the reporting date, that will be for the company NJ Limited. So let me put forward the same thing again in the form of a question and answer, and this will be question number 3 in your book. So if you can read this question, same question, the name of the counterparty in this case is B Limited, everything same except for the fact that the amount payable as consideration, that is 50 lakhs, shall be settled by issue of 10,000 equity shares of NJ Limited on 30th June, irrespective of the prevailing market price on that date. So number of shares to be issued is not dependent on the market price of these shares. Fixed number of shares will be issued for settlement of fixed amount, and as at 31st March 2020, what is question focusing on, how would you treat this in the books of NJ Limited? For NJ Limited, it will be recorded and recognized as equity instrument and not a financial liability. So let us write up the answer properly. This is the case of a contract that can be settled in entity's own equity instrument. As per the terms of the contract, fixed number of shares, that is 10,000 shares, shall be issued for settlement of a fixed amount of rupees 50 lakhs. The number of shares to be issued will be 10,000 shares, irrespective of the prevailing market price on such date. The conditions given in the definition of financial liability are not fulfilled for identifying this contract as a financial liability. As per Ind AS 32, this contract until settled, most important line over here, until settled shall be classified as equity instrument. So after settlement, anyway it is going to become equity instrument. Even until it is settled, it will still be identified and classified as equity instrument. So please write up this whole thing, and that will be your answer over here. Alright friends, I see that you would have completed this whole thing by now, and I also observe that some doubts have been raised over here. So please let me first clarify these doubts that have been asked. Doubt number 1 was in question 2, until settled it is a financial liability, but after settlement, that is after 30th June, does it become equity instrument? The obvious answer is yes, because at that date, in case of question number 2, it was A Limited, right? So you will pass an entry, A Limited's account debit to equity share capital, correct? And maybe if there is difference in the par value and the issue price, you will of course record some part even as securities premium, correct? So A Limited's account debit to equity share capital to securities premium. When you pass that entry, that point A Limited's account will be gone, and what will come in your balance sheet will be equity share capital and securities premium, which are components of equity instrument. In question number 3, for settlement of B Limited, you would pass similar entry, B Limited's account debit to equity share capital to securities premium on the date of settlement. But you know, the point was, where would be presentation of A Limited and B Limited until settlement? Until settlement, A Limited in our examples would have been included along with financial liability. B Limited in our example would have been included along with equity. That is the point of difference. That was one doubt. Another doubt that is here, in this, of course, a very good point of doubt asked by one student. See, when we are asking to classify B Limited under equity instruments, so we have logically 3 components within equity instruments. One is the share capital part, one is the reserves and surplus part, and third is other equity. So when you are classifying, it will obviously come under other equity, because it is neither part of any reserves and surplus, nor it is part of the share capital until issued. So it is still having the nature of equity. It will come in the category of other equity. So I believe you people are clear with doubts that you had by far. and if you have no doubts, I will now introduce one more very good concept over here. Suppose I am a company and you are my employee. Okay, I am a company and you are my employee. I have offered you ESOP. You know what are ESOPs? These are basically share based payments. So, employee stock option plan, ESOP. Formally, we would call it share based payment to your employees. So, you know, we have a separate topic in our syllabus classified as share based payment. Sometimes students ask me that, sir, can we start with share based payment because it's a small topic? I say, okay, fine, you start, but there is a small connectivity between share based payment and financial instruments. So, here let me introduce an example. Suppose I have an employee, you are my employee, and I have offered you some share based payment in my company. The market price of the equity share in my company is suppose 500 as prevailing market price. I am offering you shares for just 300 per share. Prevailing market price is how much? 500, and I am offering you shares at what? 300. So, for every share that you purchase from the company by exercising your right, by exercising this ESOP, you will be getting difference of 500 minus 300, that is difference of 200. And let us suppose that I have offered you 500 such shares. So, multiply by 500, the total value of this benefit that I am offering you is 1 lakh rupees, correct? 500 shares multiplied by benefit of rupees 200 per share. So, I am offering you a benefit of rupees 1 lakh. But as of now, I have given you this offer, you have not exercised this option, you still have that time, First of all, suppose I have given you this offer and then 31st March arrives. Again, I will have to deal with this ESOP and I have to identify whether it is going to be my financial liability, or because this is also as per the terms of the standard, it is also an example of a contract that will be settled by issuing entities' own equity instruments, correct? It will be a contract that can be settled in entity's own equity instrument. The counterparty over here is just my employee. So, will you classify this as a financial liability or equity instrument is the fundamental question. Answer is very simple. How much money I am asking from you? Tell me, how much money I am asking from you? A fixed amount, I am not changing that amount, right? Fixed amount is what? 500 shares multiplied by 500 rupees is the market price, sorry. So, 500 shares multiplied by 300, 1,50,000 is what you have to pay, correct? For fixed number of shares. How many shares? 500 shares. You have to pay fixed amount of 1,50,000 for 500 shares. Amount is fixed, number of shares fixed. It will not be a financial liability. It is again an example of equity instrument. If you want to think logically, you can think. Suppose I have given you this offer already that you can buy equity shares of my company at just 300. Current market price is 500. Suppose the market price goes to 600. You will still buy at 300, right? Then your benefit will be difference between 600 and 300. You people getting my point or not? Currently your benefit is how much? As an employee, what is your benefit currently? Your benefit is difference between 500 and 300. That is the prevailing market price and the offer price. If the market price rises to 600, your benefit will increase or not? Till that time, you are just my employee. You have not exercised your option yet. Option is yet to be exercised. But with the increase of the shares market price, the equivalent benefit in your hand also increases. Even though you are my employee, but you are getting same benefit what my equity shareholder would have got today. That is the logic behind treating this contract as an equity instrument, correct? And this contract will be classified as equity instrument until it is settled. Fact number 1. Because from standards language viewpoint, if you see, fixed number of shares for a fixed amount is a clear indication. Fixed for fixed will make it equity instrument. One thing becomes variable, it will be financial liability. Both are fixed, it is equity instrument. You understand, right? In any example, if the amount to be settled and the number of shares both are fixed, it will make it part of equity. Let me add one flavor to this. Before 31st March, this employee of mine, suppose you are that employee in this example, you come to me and tell me, sir, you know, you want to give us benefit of 1 lakh. You give us that benefit in cash only. No, sir. Why are you asking us to purchase shares? I say, you will be benefited by buying equity shares of my company. You become adamant. You tell me, sir, no. You just give us that benefit in cash. Then I put forward a condition that, see, if it is cash, then I will not give you 1 lakh rupees cash. I give you 60,000 rupees cash. You surrender that contract back to me. I will give you 60,000 rupees cash. You say, okay, sir, done. You give us 60,000 and we don't want this ESOP. I cancel that ESOP contract. That means I have got back that contract by making a cash payment of 60,000. So logically, I have paid 60,000 and got a contract which is to be settled in my own equity instruments. For me, it cannot be a financial asset, correct? Because originally the contract was classified as equity, not a financial liability. So when I am repurchasing this contract, it cannot be even a financial asset. So instead of reporting that as a financial asset, you will better show it as a reduction from the equity. So what I will do is, I will structure this example in the form of a question solution. So please focus again on the questions given in your book. Let me put forward this as one of the questions over here. Let us take up question number 4. Let us read this question. Mr. Milan, an employee of NJ Limited, has been offered by the company an ESOP on 31/3/2019, where the terms are as follows. Offer price or exercise price equals to rupees 60 per share. Maximum number of shares offered equals to 5,000 shares. This option can be exercised on or before 31/7/2019. Identify whether on 31/3/2019 this contract is an equity instrument or a financial liability for NJ Limited. Now friends, you know one thing very well. When the number of shares are fixed and the amount is also fixed, it will be simply an equity instrument. So how would you write up your answer? You would say ESOP is a contract that will be settled by issuing equity instruments of the entity, that is own equity instrument. As per the terms of the contract, the number of shares to be issued does not vary with the market price of the share, which indicates a fixed number of shares issued for a fixed price, that is rupees 60 per share, irrespective of the prevailing market price on the date of the issue. The terms of the contract does not qualify the definition of financial liability. Therefore, the contract will be classified as an equity instrument for NJ Limited. So friends, write up this whole thing and that will be end of the answer. Alright friends, I am sure you have completed this whole thing, and this much what we have learnt. We will be just putting an end to this session at this point, because what I would want, you all should read, revise, prepare this much very well before I begin the next session for you. So these sessions are going to be very, very important. Lot of discussions, lot of calculations involved, and gradually as and when we move ahead, the intensity of the coverage in this chapter will become more and more, the whole topic will become more and more intense. But if you want to really have good command over this, your basic understanding of these definitions that we have covered in this session is very, very important. I want you to revise this whole content very well before we take up the next session. So today at this point I'll be putting an end to this session and declare this as end of the session. So thank you very much for attending these classes, and stay connected with me, stay tuned with me, and we will be preparing this topic and all other topics. Fantastic. So end of session. See you in the next session. Thank you very much.